The Reserve Bank says it's plausible that interest rates could rise this year. Consumers aren't so confident about the economic outlook, but they're still shopping. And why big investors have turned their attention to culture and sexual harassment in big businesses. It's Thursday, the 10th of March, 2022. Welcome to Fear and Greed, the business podcast that sets you up for a successful day. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael. Hey, did you see the share price of Mesoblast yesterday?
I did happen to have a little look at it. What do you reckon?
Well, we interviewed Silviu Itescu, the CEO of Mesoblast yesterday. Its share price jumped 16.5% yesterday. No other news around, just the Fear and Greed podcast.
No announcements, nothing else, just a podcast interview on Fear and Greed.
That's right. We will take full credit. Now, it was up 5.5% the day before, but we're just going to ignore that for the moment and take full credit for yesterday's 16.5% jump.
You need to take it entirely in isolation, Sean. I find that.
That's
and
right.
Look, you're a journalist. I'm allowed to exaggerate here, and I can basically say that investors have to listen to Fear and Greed, otherwise they will miss out on basically exclusive interviews like that one yesterday with Silviu Itescu, and they would miss out on the 16.5% rise of Mesoblast.
That's right, and that homeowners need to listen to Fear and Greed as well, Michael.
That is a perfect segue for today's chat with Barry Sayoud from Pepper Money, which comes up after this episode. Really interesting chat, that one, about what's happening in the mortgage market and basically where interest rates and the housing market are going to be going over the next, 6, 12, 18 months. Which, Sean, is actually another perfect segue. Look at us. We're just rolling straight through today into our first story of the day. Reserve Bank Governor Phil Lowe has said the supply-side shocks in the global economy caused by COVID and the war in Ukraine could trigger higher inflation and, in turn, faster interest rate increases.
Yes, Dr. Lowe said the risks to inflation have certainly moved to the upside, but his central case scenario remains that inflation in Australia isn't out of control and won't reach the levels experienced in the US, where consumer prices are rising by 7.5%. The big difference between the two countries is that local energy costs and wages are growing far more modestly in Australia than in the US and Europe. Wages remain critical, as they have been for more than a year. Dr. Lowe says wages growth is currently 2 point something, and pay rises next year will be in the 2 to 3% range across the economy.
Now, Sean, I want to get this right because I thought this was interesting. Dr. Lowe spoke quite a bit, not necessarily about what's going to happen to prices, but what people think is going to happen to prices.
Exactly. Economists call it inflation expectations. They're really important. Think of it a little bit like the chicken and the egg scenario. Workers think prices are going up because it costs more to fill up their petrol tanks, thanks to the war in Ukraine, or fruit and veggies cost more, thanks to the floods along the East Coast. In reality, everything else is about the same price. But because consumers think prices are rising, they go and demand higher wages. And they can do that because the labour market's tight. Business then puts up the price of those products to make up for the higher wages, and it actually becomes self-fulfilling. Wage expectations are a really interesting phenomenon within the economics discipline. And that's what Dr. Lowe was talking about yesterday. Now, he's saying it's plausible that rates will rise this year, which is a fair shift from a few months back when 2024 was a preferred option. But Dr. Lowe also warns going too early has risks as well, namely culling the push towards full employment. Michael, the drums are certainly beating. Both AMP and Commonwealth Bank now expect rates to rise in June. That's just a few months away. National Australia Bank expects it to happen in August. On Tuesday, former Federal Treasurer Peter Costello called on the Reserve Bank to lift interest rates. As I said, the drums are beating.
Sean, did you just do what I'm going to call an economics lesson sandwich? You started with interest rates, you finished with interest rates, and in the middle you managed to squeeze in a lesson in economics for me, and I actually think I followed it.
That's unusual, Michael, that you did follow anything I said about economics.
What, you can actually hear my eyes glazing over at times as soon as you start getting into these principles, but you hit it neatly in between speculation about interest rate rises. So you did that very well. How did the local equity market perform yesterday, Sean?
Well, the S&P ASX 200 ended up 1% to 7,053 points. Telstra led the way among the large caps, up more than 3%, while Commonwealth Bank and National Australia Bank both finished nearly 2% higher. The gold stocks also did well on the back of the precious metal pushing beyond $2,050 an ounce, close to a record high. Tech stocks generally outperformed, led by WiseTech Global, which finished 6% higher.
Sean, the most interesting stock yesterday, well, I personally think it's Mesoblast going up 16.5% on the back of a Fear and Greed interview. But putting that to one side, the second most interesting stock yesterday was Nickel Mines, fell 23% at one point.
Yes, and that was enough to trigger a pause in share trading after one of its biggest shareholders, a Chinese-based business, lost out on the booming nickel price. According to Bloomberg, the shareholder shorted nickel, as in took a bet against nickel prices rising, and then watched the price of the commodity spike nearly 250%. That's how you lose money big time. Trading in nickel was actually suspended by the London Metals Exchange yesterday morning due to the extreme volatility in the commodity. Now, by the end of the day, Nickel Mines had come out and said that shareholder had communicated with them and was going to retain its shareholding in the nickel company. Good news, by the end of the day, its share price was down 4.75%, much better than the 23%, where it was at about 11 o'clock yesterday morning.
Yeah, absolutely. What about global markets?
Well, Michael, it was quite a night. Oil fell sharply, down 15%, after the United Arab Emirates and Iraq signalled OPEC may raise output. And Ukrainian President Volodymyr Zelensky said he's prepared to make certain compromises with Russia to end the war. Mr. Zelensky's comments led to falls in most major commodities and a surge in European markets. Germany's bourse, for example, was up 7% overnight, its best in 2 years, while the Europe Stoxx 600 closed 4.7% higher. Wall Street was also up, with the S&P 500 rising 2.7% in early afternoon trading, while the tech-heavy Nasdaq was 3.4% higher. It augurs very well for a strong day on the local market.
Okay, we'll be back in a moment with the rest of the day's business news. Sean, Wesfarmers boss Rob Scott yesterday said consumers are showing a greater sense of confidence and optimism, just as a major survey shows confidence declining.
Yes, well, Michael, economics really isn't an exact science. I think we've learnt that on Fear and Greed over the years.
I think we have.
Mr. Scott, whose company runs Officeworks, Bunnings, Kmart and Target, said consumers were happier as they emerged from COVID. Low unemployment and high household savings were spurring confidence. However, inflation pressures were worrying, and businesses were facing wage pressures around staff, particularly in specialist areas like IT and engineering. These are the areas where the big pay rises are flowing through. Now, his comments came as the Westpac Melbourne Institute of Consumer Confidence turned negative for the first time since the start of the COVID pandemic. It's not surprising, really. While COVID is less of a concern, the war in Ukraine, floods, inflation, and the potential for higher interest rates are all hitting consumer sentiment. What's all this mean? What's the upshot of it? Well, consumers are definitely turning more gloomy, but so far, they haven't stopped shopping.
I love a simple one-line explanation for me. Thanks, Sean.
It's an economics lesson today, Michael.
It really is. So far, that's, 2 or even 3. And you taught me about short-selling nickel as well. So I've learnt 3 things from you today, Sean. We're only halfway through. So who knows what I'm going to learn before we're finished.
It's a big day.
All right. Now, the fight for AGL Energy, Sean, isn't quite over yet, with the vice chair of Canadian giant Brookfield challenging the group's board to prove its demerger option is a better option.
That's right. Brookfield, in conjunction with tech billionaire Mike Cannon-Brookes, bid for AGL 2 weeks ago and promised to close coal-fired power stations earlier than scheduled. The AGL board rejected the bid, which initially was at just a 5% premium to an already hammered share price. They came back and offered about a 15% premium, but the board certainly was within its rights to reject that bid, given the price. Brookfield's Mark Carney, who previously was the governor of the Bank of England, so he knows what he's talking about, yesterday warned that companies that acted slowly to reduce emissions and deploy capital to implement the transition to low-carbon energy would lose out. And he believes the current AGL demerger plan, and that's to split the clean business and the carbon-emitting assets, isn't the best outcome for shareholders. Michael, the trouble for AGL Energy's board and executives at the moment is they're sort of on a hiding to nothing. It has very vocal adversaries and it needs its demerger plan to work. And that's really the big unknown, whether or not it will work. It's going to be a very, very difficult time for AGL Energy's board and management.
Yeah, certainly will be. Now, Sean, how much debt is too much debt? Now, I don't know whether there's an answer to that question, but this is a pretty remarkable figure. Australia's combined state government debt will exceed $500 billion in coming months.
Yes, according to S&P Global Ratings, state debt levels will reach 23% of GDP by the end of this year. It reflects all the economic support packages that have been rolled out over the past couple of years and, given the floods, are still being rolled out. There's plenty of refinancing of ongoing infrastructure projects going on too. That ups the debt as well. Victoria is the standout, with gross debt quadrupling between 2019 and 2025. West Australia's debt isn't growing. Not really surprising given the royalties they get from the commodities boom. Does it matter? Well, it does, because the debt has to be paid back at some point. If a state has a lot of debt, but the money's being used to improve productivity and help the state grow, then it's quite easy to repay debt, or it's less hard to repay debt, shall we say. However, if that debt isn't being used wisely, a state can find itself in a real financial pickle in 5 or 10 years' time.
Okay.
Hold on. I think I just gave you another lesson.
Oh, is that 4? 4 lessons so far.
PB.
That is a PB, and I just know that you're going to squeeze another 1 or 2 in before we go. We'll try and make them painless lessons, if possible, for the listeners.
As opposed to the previous 3. Go on.
That's right. Now, Sean, what's the latest on the floods in New South Wales?
Well, the Prime Minister, Scott Morrison, yesterday declared the New South Wales floods crisis a national emergency, which will free up more help from the Defence Force and financial assistance payments. Officially, Sydney has had its wettest start to the year ever, with almost a year's worth of rainfall in just 10 weeks. Almost half of that has fallen in the past week. Floodwaters peaked yesterday, and with little rain expected in the next couple of days, waters should recede. There are no other major rainfall events expected in the foreseeable future, fortunately. Now, flood victims in Queensland and New South Wales have so far submitted 108,000 claims, worth about $1.5 billion. Insurers estimate the total cost of the flood crisis will eventually be more than $3 billion.
Okay. Sean, US military intelligence officials expect Ukraine capital Kyiv will be taken in the next fortnight.
That's right. Appearing before the House Intelligence Committee, officials said Russian President Vladimir Putin may have been surprised and unsettled by the resistance encountered in Ukraine, but he's determined to succeed. He's likely to use even more brutal means, and Kyiv will probably only last another couple of weeks. It's certainly sad what's going on, and it is quite frightening what could happen if Mr. Putin is determined to break through and take Kyiv.
Yeah. Now, I mentioned this one at the top of the show, Sean. The Australian Council of Superannuation Investors has warned that cultural issues such as sexual harassment in the workplace could become the next big thing for corporations to worry about.
This is really interesting. Now, the council represents some of the nation's biggest superannuation funds, who are the nation's biggest investors. So what the Council of Superannuation Investors thinks really matters. In recent years, it's been much more about climate change and ESG, environment, society and governance. It's turned somewhat, and culture and how companies operate internally has become much more important. Yesterday, the Council of Superannuation Investors boss Louise Davidson said sexual harassment was next in line to get a lot of focus from those big investors. She said the recent report into Rio Tinto's culture, which highlighted problems from sexual harassment to sexism and racism, raised the bars in terms of discussion about the challenges in the mining industry and beyond. Now, Ms. Davidson actually congratulated Rio for making that report public. She warned that companies could find themselves at a financial disadvantage if they didn't take cultural issues such as sexual harassment much more seriously.
Okay, Sean, what's making headlines in today's news media?
The Australian is reporting that the Prime Minister Scott Morrison will today announce the Defence Force's biggest expansion in 40 years, increasing the military by at least 18,500 soldiers, sailors and aviators to respond to growing strategic threats posed by China and Russia. The $38 billion workforce boost will expand the uniformed force to almost 80,000 by 2040 and take the number of permanent defence employees to more than 101,000, including public servants. And the Financial Review is reporting that the chief executives of Australia's two largest oil and gas companies have predicted soaring energy prices could last for decades as multiple nations turn their backs on Russian supplies.
All right, running through some of the other stories around today, Coles chief executive Stephen Kane told the Financial Review Business Summit yesterday that the nation needs to rebuild better its infrastructure to cope with the expected rise in population and the strains that it will put on supply chains, businesses and economic activity. He said the floods in New South Wales and Queensland had knocked out farms up and down the country and threatened the supply of vegetables.
Origin Energy's share price jumped 1.4% yesterday after it announced a $250 million buyback. Another strong performer yesterday was Aristocrat Leisure, which rose 4% after saying Russia's invasion of Ukraine won't have a material impact on its earnings. Aristocrat has about 1,000 staff working in Ukraine.
Westpac, Sean, is inviting bids for its wealth management unit BT Panorama. According to Bloomberg, a deal could be worth as much as $1.5 billion and indicative offers are due at the end of April.
And Michael, Energy Minister Angus Taylor said boycotting Russian oil would have little effect on Australia's fuel supply because it accounted for just 1.5% of crude imported. Remember, yesterday, the US and UK said they were going to take steps to block oil imports from Russia.
Okay, what's the key overseas news this morning, Sean?
More and more global companies are pulling out of Russia, Michael, in protest of its invasion of Ukraine. Over the past 24 hours, it's gotten really serious. McDonald's, Starbucks, Coca-Cola and Pepsi have all suspended their Russian operations. In McDonald's case, the fast food group will close all 850 restaurants where it employs 62,000 people.
Wow.
When you see all these groups doing this, you really understand how business must be hurting Russian people just by taking their jobs from them.
Yeah, certainly. And it makes you wonder what kind of impact that would actually have then on President Putin's decision-making. Unfortunately, I suspect not much.
The problem for Russia, though, is that they could run out of money. I mean, Russia could easily default. And if that's the case, where do they get the money to pay their people?
Yeah.
Very tricky.
It's really the economic consequences of a war. And it also shows the power of the Western world to really impose sanctions that can entirely cripple an economy.
Absolutely. Michael, Apple has launched a new version of its budget-priced iPhone that's capable of connecting to 5G wireless networks. The new iPhone SE will sell for $719 in Australia and be available from March 18. Apple's also launched a new high-end desktop computer using its own M1 chips as it pushes to grab a greater share of the PC market. The Mac Studio starts at just under $3,000. Now, the goal is to push its share of the desktop market, currently at just 2.3%, closer to 17% globally, which is Apple's share of the smartphone market. Until 2020, Intel used to make chips for all of Apple's desktops, but in the past couple of years, the tech giant has gone out on its own. And finally, Disney, the conglomerate that spent decades building its image as a family-friendly destination, is pushing into sports gambling. Its cable sports network subsidiary ESPN continues to lose subscribers, though it does generate plenty of cash. So management at Disney wants to push into betting. Individual states in the US have been opening up to online gaming over the past 12 months. There's the opportunity, and Disney and ESPN want to take advantage of that. Disney CEO Bob Chapek said the future of sports programming will extend to sports betting, gaming, and the metaverse. I wonder what Walt Disney thinks of all this.
I have absolutely no idea, but I can assure you that Disney in our household with young kids is really only used to watch Moana and The Lion King.
I know, they'll be betting on The Lion King shortly, your kids.
Who's going to win the stampede in the gorge?
That's right.
Oh, goodness me. All right. Now, Sean, up next is the Fear and Greed daily interview with Barry Sayoud from Pepper Money, a supporter of Fear and Greed.
That's right. As you mentioned at the top of the show, great chat about what's going to happen in the mortgage market, what's happening with interest rates. Also, Pepper Money lend to commercial businesses and what's happening in that sector as well.
That's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Sean, 4 economics lessons today. I think that is definitely a personal best.
I think so.
Please don't try and break it.
Oh, enjoy your day, Michael.
There's only so much I can learn, Sean. It's Thursday, the 10th of March, 2022. Make sure you're following the podcast and join us online on LinkedIn, Twitter, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.